Hello everyone, welcome back to the Intelligent Investor Book Overview series. In this book, father of value investing Benjamin Graham has covered almost all the explanations one would seek either as an amateur or a new investor or an experienced one too. Graham has devoted 3 chapters exclusively for defensive investors, which are Chapter 4 on portfolio policy, Chapter 5 on common stocks, Chapter 14 on stock selection. So I am planning to post these 3 videos continuously so that it will be handy for prospective defensive investors. Now on to chapter 4 where Graham guides us through the portfolio policy setup. In this chapter, he has discussed about returns risk relevance and allocation of stocks and bonds, where Graham explains about bonds in this chapter and stocks in chapters 5 and 14. The third aspect is on age, but which Graham least cared about. The basic approach of a portfolio creation is to be intelligently carried out immaterial of the investor being defensive or enterprising. Benji takes a diversion from the popular saying of returns being proportional to risk taken. He firmly believes that if investors invest intelligent efforts in creating a portfolio, importantly keeping cost and emotions under control, then investors need not be worried about their returns. This directly or indirectly alludes his core philosophies of conducting thorough analysis, thereby safeguarding a principle resulting in adequate returns. So, considering the limited amount of time spent, research efforts taken, the defensive investor must be willing to accept an average return. On the other hand, enterprising investors will achieve greater returns as they make additional efforts in managing the portfolio as and when required. Now, on to the debatable topic about the allocation of stocks and bonds. Stocks and bonds have its own merits and limitations, which will be discussed partly here and will be touched upon as and when we move to the subsequent chapters. To put it simple, Benji suggests though the proportion of stocks and bonds is purely based on individuals' need and time available to research, but the fundamental guiding rule is that the investor should never have less than 25% or more than 75% of funds parked in common stocks, with an inverse range of between 75% and 25% in bonds. Considering the pros and cons of stocks and bonds and the attributes of a defensive investor, Benji recommends equal proportion of stocks and bonds, meaning for defensive investors 50% in bond and 50% in stock, which is an all-purpose formula. In case of bull market, adjust your additional money added to your stock into bonds to maintain 50-50 target, and in case of bearish market, try to rebalance by pumping into stocks, that is buy cheap. Importantly, he suggests 50% both in high grade stocks and high grade bonds respectively. Well, now why 50-50? It is dependent on individual personal background and risk taking ability. So he asks us to answer the questions shown here and place yourself accordingly. Given in any circumstances, he doesn't advocate anyone to invest 10% in stocks. It is also important to know that cash deposits or fixed deposits, which are quite popular in India, may not be a favorable avenue to invest your money. Because if you work out the interest rate and deducting tax for that and adjusting it to inflation, the net resultant might end up eroding your principal. Now, the next immediate question to all investors would be how to choose a stock and bond. As I just mentioned in this chapter, Graham discusses about bonds, and in chapters 5 and 14 he has discussed about stocks. Various types of bonds, its advantages and limitations during the times of ups and downs, and how the bonds responded to such fluctuations, and also how they behaved through crash markets have well been covered in this book. So his suggestions are based on all these learnings and interpretations. As we know, a bond or debt is nothing but lending money to an organization and in return receiving interest periodically on your lent money. Bonds are mostly issued by PSU or by government companies and hence considered safe as far as principal is concerned, and also low risk investment avenues having a fixed rate of return. This captures the essence of Graham's definition of investment. However, they don't give returns as high as equity or stock investments. So while choosing a bond, one should look for 4 aspects. Look for the tax component if it were a tax-free or a taxable one. This is basically a mathematical calculation based on the investor's tax bracket. Second one is about the duration. The question of maturity should be based on the investor's perceived need for yield and risk or opportunity of a change in principal value. The third one is about the type of the bond in itself, which could be various types of bonds or bond funds. Benji goes for bond funds as they offer cheap and easy diversification. The last one is about the charges. Keep tracking the fees that incur in holding or changing. The fees may be commission or transaction costs, etc. The choice of the above factors are also dependent on where you are investing. In case if you are investing in US and you are in the above average tax bracket, one should go for tax-free bonds. Whereas if you are keen for some good taxable bonds, you can always try it through 401k scheme, so it might get into tax-free band. Whereas if you are investing in India, better to look for tax-free bonds. In addition to the above mentioned four factors, you may also wish to check credit ratings given to these bonds. AAA generally refers to the safest bond. Say in India, there are about 50 plus companies rated AAA, whereas only two companies, that is Microsoft and Johnson & Johnson in the US, enjoy this distinction. And I think no company in Germany or UK enjoys AAA rating. The major difference is that the companies listed in India are PSUs or quasi, whereas in US they are private sectors. That is the reason we had to say that choice of the bonds are dependent on the location. Number of bonds available are categorized here as government bonds, state and municipal, treasury, high yield, preferred stocks, etc. In this book, Jason Zweig has compiled a list of bonds available with all factors that we just discussed. That is the type of bond, duration, coupon rate and tax component. And you can see that in this table. It is important to note that if the interest rate goes up, it is not good for bonds, and when the interest rate goes down, the market price of tax-free bonds rise. In other words, if one has to compare investing in fixed deposit, say the interest rate in SBI is 5.7% as of today, and having paid TDS reduces overall returns. Whereas if one opts for a tax-free bond from the same bank SBIN, which yields a coupon rate of 9.95%. Obviously, returns are better than an FD. Finally, please note that Benji doesn't recommend preferred stock for defensive investors, but instead asks to look out for high grade bonds. If one is keen to know the updated features of the bonds and bond funds, one can refer to this table. And just to give a feel of bonds listed in India, I am showing you the list from NSE website, which gives you the credit rating, tax component, duration, etc. Similar to stock indices, that is S&P, Nasdaq, Dow Jones, there are bond indices which track the performance of bond portfolios. Say for example, the one shown here is Barclays index with a gamut of bonds included. Interestingly, Graham has never related age and investments. He wanted investors to focus more on the policy of investing rather than at what age are you investing. Probably that may be the reason Warren Buffett, even at the age of 90 years, is still into diversifying and just don't go by the conventional rule of thumb to find out the proportion of stocks and bonds in his portfolio. That is, which says subtract your age from 100 and invest that percentage of your investments in stocks and with the rest in bonds. Jason Zweig has explained that with an example. Assume that there are two people. One is a 90 years old lady who has a fortune of $3 million on top of the ample pension. So going by the logic of conventional formula, she should invest in 90% bonds and 10% in stocks. And on the other hand, there is a 25-year-old man with average income, saving money for purchasing a home, getting married, etc. Where according to the popular formula, he got to invest 25% in bonds and 75% in stocks. What do you think would be Benji's take on this? Definitely, he doesn't suggest the old lady to invest majorly in bonds. Instead, it is the other way around. He suggests to go for more in stocks and less in bonds, whereas the young man cannot or should not take risk of investing his money in stocks. Instead, better to park his money in safe schemes like bonds. So don't get carried away by the conventional wisdom. One needs to analyze it personally. If we have a look at 90 years old Warren Buffett portfolio, he is far way young with his own investing strategies. He follows the rules of his mentor Graham. He invests in business that he understands and with favorable long-term prospects and which are operated by honest and competent people and available at a very attractive price. So we can see his basket has a mix of mid-cap and large-cap funds and more into diversified sectors which include technology, financial services, defensive, consumer, healthcare, basic materials, real estate and so on. And importantly, the amount of stock is definitely much more than the bonds, as you could see from this chart. So finally, the takeaway message is that the amount of risk you assume should have nothing to do with your age. Having said this, one may ask if Warren Buffett is an active or passive investor. I am just assuming that he is a mix of both. To wrap it up, let me outline the important takeaway message for a defensive investor. As a matter of policy, hold 50% stock and 50% in bond. Choose high grade bonds and stocks. Third one is better to go for bond funds. Graham strongly says a no to preferred stocks and also a big no to high yielding bonds, and definitely no to 100% stocks, and last but not the least, investment and age are not related. Thanks for listening. Happy and healthy investing.